This is a special report. Thanks for joining us at xam.com. The Japanese yen has fallen off a cliff lately, nearly touching a 3-decade low against the US dollar earlier this week, putting the risk of another round of FX intervention on the table. I'm Cristina Marujas. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, the main question now on traders' minds is whether, and more crucially, when will Tokyo intervene in the FX market? Do you think that's a likely scenario? And if so, at what levels could the Bank of Japan step in?
Hello, Christina. I do think it's a likely scenario. In fact, I think the risk of FX intervention has been rising lately, but I also think we are not quite there yet, and let me unpack that. So we've seen the yen, as you already alluded to, the yen has fallen very dramatically lately. It's down more than 13% this year against the US dollar, which is a huge drop. And the main driving force behind this weakness has been interest rate differentials. So the Bank of Japan has refused to raise interest rates. They've kept interest rates in negative territory, even as foreign central banks like the Fed have raised their own interest rates to 5% or even beyond. So this enormous rate gap is pushing capital out of Japan, essentially. Capital is looking for higher returns abroad outside of Japan. And of course, we've seen high energy prices are also negative for the yen because Japan imports most of its energy from abroad. Now, what I find striking is that this month, Christina, in November, both of these forces, interest rate differentials and oil prices, lost their punch. We saw US bond yields coming down, oil prices have declined, and yet the yen was unable to recover. These positive developments were only enough to stabilize the yen, which I think underscores how negative the sentiment around the yen is. Traders are extremely reluctant to buy the yen, even though we've seen slightly positive developments lately. So now the question becomes, how likely is FX intervention? Well, I think the risk has been rising. So the yen is already trading at the levels where Japanese authorities stepped in last year. But I don't think intervention is imminent. I don't think intervention is going to happen right now. And the reason behind that, Christina, is the rhetoric from Japanese authorities. So the final authority in intervention matters is the Minister of Finance. So the government decides whether to intervene in the FX market. And if you listen at some recent comments from the Minister of Finance, yes, he said we will take all possible steps to ensure that we will respond to currency moves, but he hasn't used the buzzwords that they used in the past right before intervening. So he has not described FX moves as being one-sided or disorderly. Those are the catchphrases you would expect to hear right before they intervene. So the fact that the absence of urgency in his tone suggests to me that we are still some distance away from FX intervention. So a lot of strategists believe that the catalyst for intervention would be if the pair dollar-yen breaks above 152. However, considering the comments from the Minister of Finance, I think that the real threshold for intervention might be higher than that. And I would be looking very closely, if we break above 152, I would be looking very closely at the 155 area. That how the government and how Japanese officials sound as the yen approaches this area, that would be the indication of whether they're about to intervene or not.
I see. And now, looking ahead, Marios, is a trend reversal in the cards for the yen?
I think so. So let me break that down. In the near term, for now, I still think that the outlook is negative. As I already mentioned, we've seen some positive developments lately, and the yen couldn't capitalize on that. So as long as the Bank of Japan remains so hesitant to phase out its stimulus program in particular, I think the yen could remain under pressure. And that's why I think we could see another round of intervention. That being said, I also think that we could see a trend reversal next year. And the reason behind that is monetary policy. So we mentioned interest rate differentials earlier, right? Well, if you look into next year, you have a situation where the global economy is losing momentum and some regions are about to enter a recession. So the markets are anticipating a rate cutting cycle to begin around the spring, April, May. So as we get into the spring, I think the yen could get some relief from foreign interest rates falling. And at the same time, we could see the Bank of Japan tightening policy a little bit, perhaps by exiting negative interest rates or by abandoning their yield curve control program, which is what the strategy that has crippled the yen. So I think next year we are looking at a situation where interest rate differentials compress again, and that allows the yen to breathe a sigh of relief, and perhaps that could be the catalyst for the trend reversal as well.
Marius, thanks so much. This was a special report on the yen. Thanks for watching here at xm.com.